The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm your host, Brian Akers. Here with me today is certified financial planner practitioner, Alex Monk. He's been in the industry for more than 10 years now. He knows what he's talking about, which is good, and that's why we invite him to be on the show. Good morning, Alex.
Brian, it's good to see you.
It's good to see you. I hope you're doing all right this morning, and I hope you're ready to go.
Oh, man, I was born ready.
Born ready for what, though?
Yeah, that's the question.
Well, let's focus in on one thing today, and that is this. We got a good show. Oh, all right. It's a great show. It's called 4 Investment Secrets for Your Retirement Future. Yes, some mornings I wake up and I have to create a radio show, and boom, this popped out of my brain early in the morning. 4 investment secrets for your retirement future. What we tried to do for the show today is, just like normal, our game has 4 quarters. And in our game 4 quarters, we're going to present 4 different topics, the 4 investment secrets for your retirement future. They're fundamental. They are things that you must think about and you must rethink about and then apply to your exact situation. All right, so Alex and I are certified financial planner practitioners. I'm at Akers Financial Group. We're a registered investment advisors, stockbrokers, insurance agents, got all the different licenses. But we enjoy hosting our show, Winning in Retirement. All right, Alex, you ready to get going?
Let's do this.
All right, the first topic is called dollar cost averaging. And I know it's one of my favorite ones, but I thought I'd give you a minute to talk about it before I just take over.
Well, in the biz, they call it DCA.
In the biz? Okay. I thought that was abbreviation for an airport.
That's also true. So, dollar cost averaging, it's, and I tell people this all the time. It's like, do you want to pick one day? One day, right? So if you pick one day and that's your entry point into the market, is that a good day? Right. And we know the market's going to be volatile. So let's take advantage of that and slowly start to buy investments over time.
There's an article back in 2012 put out that lump sum investing is better than dollar cost averaging. And my first response to that is, all right, who has the lump sum? Almost all of us have to save out of our pay. We got to save out of what we bring in. If we don't save the small pieces, we'll never have a large piece. Once in a while, a lump sum will drop in, but not often. It might be your after you retire before you see your first lump sum of a lifetime. But the concept is this. Dollar cost averaging is a process that all of us do when we are just saving at our own retirement plan through our work. Coming out of every paycheck, you are investing on an ongoing basis, which is a very good thing.
Especially when the market is volatile, right? And when you're saving, you don't think this, but you want the market to be down when you're saving.
Exactly right. I mean, my favorite day to buy is when it's low, when it goes down. Hey, it's down 10%, let's buy. That'd be great. The problem is you never know when that day is going to be. And one of the great things about like a 401k, TSP, is that it comes out of your paycheck, you can invest. Now, fundamentally, we recommend that money ought to be going into the stock market, buying the volatility piece. The core portfolio you might want to reallocate into the lower risk, but the ongoing payments ought to be into the risky volatile side.
That's an important point that you bring up, right? You want the money to be going into risk assets, or the dollar cost averaging doesn't really matter.
Absolutely. Let me give you a short little math story of why dollar cost averaging works in a volatile market. Let's just use a pretend stock, and it's $10 a share, and we're going to invest $100 a month for 6 months. Just real simple. When you invest you invest in a stock that's worth $10 a share. You put $100 into it. How many shares do you buy, Alex?
It sounds like 10.
Exactly right. So amazingly, after 1 month, you put $100 in, you have 10 shares. If the stock drops to 7 in February, the next month, you put $100 in. I'm not going to make you do the math on that, but you end up buying 14.3 shares.
Thank you.
Alex, explain why you get more shares when the price goes down.
Is that a trick question?
It should be an easy one.
I mean, when the price goes down, you can buy more of it with the same amount of money. The utility of your dollar goes further.
It's like when you get soup cans, 10 for $10. It's a good deal. You get more. All right. And now in March on this story, the stock kept going down, went down to 6. And the investor put $100 back in, and they got 16.7 shares. And then in April, the stock started moving back up to 8. They bought 12.5 shares, went to 9. They bought 11.1. So in the first 6 months, they invested $500, but their average purchase price, because they're buying throughout time, was $8 a share instead of the price being back at $9. So even though the market went down in my little story here, it went from 10 to 9, the client average purchase was 8, actually made money in a market that was curving down and then coming back.
And, that sounded really boring, right? It took time. They didn't sell it. They didn't buy it. They weren't trying to trade it. They were just slowly but surely saving money.
They held it more than a month or more than a day. Yeah. So if you're out there investing money and you're probably having fun trading and it's more of a game to you, we believe that that's a game you're playing. It's not the investments that we're talking about, which is the core piece for your portfolio for your lifetime. Investing is for your lifetime. It's for when you can't work, when you need your money to work as hard for you as you do for it. We save our money and we put that money away. The dollar cost averaging, I believe what we should be doing is dollar cost averaging every paycheck, every month into the market.
Yeah, and it's nice because then you don't have to pick the right day. I mean, how do you know? It seems foolish of me to not spread your entry point.
Exactly right. But most people are already doing this. But then some people actually, out of their paycheck, they buy a stable value fund at work. And then they try to buy into the market later if the market dips down. And so they're trying to guess. We believe that dollar cost averaging, and especially when you're dealing with your retirement plan, is the way to buy the stock market and to buy the ups and downs. When you have a market that's been going up for many years in a row, you got to think about there's going to be a lot of volatility. If you think back in history from 2000 to 2010, the S&P 500 was negative for the decade. Yes, people don't like to remember that because they like to be index investors, but how about your investments being negative for a decade? Now, if you invested during that decade on a dollar cost averaging during a up and down volatile time, you would actually make money because you're buying the volatility. That's the key ingredient to this first secret.
Yeah, and look, what you said there is the money should be going into these risky assets, but there's no issues with taking money off the table. But we want the volatility. Like the stock market's this weird thing where when it goes on sale, people don't want to buy it. It's like, well,
oh no, it's going down. It's going to go down forever.
Right.
And that's the whole fear, hope, and greed concept. And that is this. When the market's doing great, we get real hopeful and then ultimately greedy, and we keep buying more and more at the peaks. When it starts to come down, we get a little hopeful it's going to turn right around real quickly. But what happens is this. The market drips down a little bit more, and gets to a pain point. And instead of buying when you're fearful, you actually want to sell. And you do emotionally the wrong thing. Dollar cost averaging takes the emotions out of your investing and is the right way to build your wealth over time.
Yeah, and that's how Warren Buffett did his thing. I mean, dollar cost averaging, dividend reinvestment. I mean, that's the way to do it. Because even those dividends, as they accumulate more shares for you, it also raises your next dividend because you have more shares. And it's like a snowball effect.
Yeah, snowball, like snowball up. Snowballs roll down, right?
Yeah, so let me think about that.
I'm sorry. I thought it was funny to question the snowball concept. But the idea is that the snowball gets bigger and bigger and bigger, and your accounts get bigger and bigger and bigger because you consistently invest. The amazing thing is this. When do we start with new investors? The day they walk in the door. Now, if you're 18 years old and you want to save money, we look forward to helping you because you want to walk in and save money. People that want to save become great clients for financial advisors because they understand the concept, and that is this: save. That's how simple it is.
It's one of my favorite things that you say, Brian, is, well, when should I buy stocks? When you have the money.
Yeah, it seems obvious is the best time to buy. The problem we have with people is that they believe that the market's going to go up and down exactly the way they think it will. They also try to guess entry and exit points. They also think every year has this foreboding happening that the market's going to go down because of whatever reason this year. And the reality is that there is something like that every year.
Absolutely.
The market actually usually has like a 14% downside in most years. So you can see the market average actually drops 14% during the year at some point in time. Then it goes up or down from there, depending on what's going on.
It's like the elevator business, right? It has its ups and downs.
I need a drum roll for that one. I think I got one on my board here.
Right, but this volatility, Brian, is a good thing when you're saving. We want that. That really gets you a better entry point, just like the story that you told earlier. And by slowly doing it, you can accumulate, and then you just really need to watch your asset allocation as you save.
The dollar cost averaging is a part of life where you choose to do it. Can you imagine saying, oh, I'm going to invest money once I've saved $2,000, $3,000, $4,000? You know, it takes a while to get that kind of money set aside to invest. Some people can invest it every month because they have incredible cash flow. Other people struggle to find the $100 to $200 to get started. The main idea in saving is save what you can now and save for your future. The reason is that you care about your future while no one else probably cares as much as you do. As advisors, we care for our clients. We care for what's going on. We try to take advantage of all the markets that are out there and try to guide people to achieve the very best for them and their family. And that's why we want to tell you for these 4 investment secrets. The idea of dollar cost averaging is something you need to think about and see if you are really implementing that at your work on your monthly savings. Are you truly dollar cost averaging? Are you just dollar saving? If you're dollar saving into a stable value or something that has like a savings account, you need to be buying the market.
Yeah, absolutely. And if you have a fund and you only have one of them, you need to figure out what's in there. Because a lot of times, depending on how your age is or however your money's allocated, you may not be buying the right things.
Yeah, it's when you get a new client, they always say, "Well, how would you invest the money now? When would you enter?" And then we go through some basic ideas. Well, let's dollar cost average. I don't know what the market's going to do, especially if they're a new client and we have cash sitting there. We need to get it into the market for the market portion. When you look at your investments in your 401k, think about the contributions as being more aggressive than the core money that's already there. Maybe you reallocate the 401k, but then change where the contributions go. You're allowed to do that on their website. We believe that you need to set things up for your retirement because when you get to retirement, you want the biggest worry of your day to be where you're going to drink your morning cup of coffee, where every day seems like a Saturday, free of stress. Your retirement income and investments are taken care of by a team of advisors at Akers Financial Group. This is the future you want. It's not too late. We'll help provide this by you giving us a call for that free meeting, a free review of where you are. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and we'll give you a call back on Monday to schedule an in-person meeting with one of our team of advisors. Start planning now for your retirement. Call 833-946-7384 or visit our website at akersfinancialgroup.com. When is it time to get into the market? We'll answer this in the second quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Mr. Announcer just welcomed you back, but I'm going to welcome you back also. Welcome back to Winning in Retirement. I'm your host, Brian Akers. I'm president and founder of Akers Financial Group. And here with me today is Alex Monk. Alex Monk's a certified financial practitioner and has been with us here at Akers Financial Group for almost 10 years. All right, Alex, I'm sorry. Oh, my goodness. It's funny to call you different names. Well, how about let's go with Monk this time, or Alex?
I'll take it. Either one.
All right, let's go. I'm sorry. All right, back to the real show. All right, when is it time to get into the market?
So I've heard that during Ravens games, Wegmans is usually pretty empty. Wait. What's the question?
Oh, my. This show's gone downhill ever since I called you Prince Eric from Ariel. All right, so when is it time to get into the market? Let me explain it better. When is it the best time to get into the stock market?
Oh, so yeah. You got to pick the bottom. Yeah.
Pick the bottom?
Yeah.
All right. Now, what's going to happen here is sometimes I just have to answer, I got to come out and say, guess what? The best time to invest the money is when you have it. There are times in life when we don't have the money to save or invest. But when we have the time, the money, and we're ready to invest, we need to go ahead and invest. That investment needs to be thought out, needs to be planned out, needs to have purpose to it. When you invest with purpose, you can then pick the investments that tie into it. If your money is investing for 3 to 5 years down the road or longer, and you truly are trying to grow it, then you should put your money in stock market. Now, which part of the stock market? It's all part of the risk tolerance, the planning, how to bring it all together. one of the things that you do not want to do is try to guess the market in and out. Put your money in, pull it out, and that's called what, Alex?
That's called gambling.
Yeah.
No, wait, no. So, it's funny because people, when you meet them and you talk to them, you always hear about the winners, right? You never hear about the losers until you see the tax return.
Oh, that's so true. I mean, when people are telling us a story, oh, my brother-in-law, he's made all of his millions off of this all these stocks, trading it.
Yeah.
It's like, well,
my cousin bought Bitcoin for 13 cents back in blah, blah, blah.
Yeah, and I hope they did. I mean, it'd be great.
Yeah.
I mean, the idea is if you do buy something really low and make a lot of money, that's awesome, incredibly well. The problem is you still got to apply the following secret. This is out of our 4 investment secrets, our number 2 secret is this, and that is market timing won't work.
No.
You have to make 2 perfect decisions for market timing to work. If you're in the market, let's say you have a 401k plan where you can trade in and out anytime you want. And some people do this. They'll be investing in 401k and have a well-organized portfolio, and then one day get a little nervous and they pull the plug and they go to cash.
Yeah, and then you see him like 6 months later. It's like, well, what happened?
Yeah.
Oh, I got scared.
I like the one where, I got out before the market crashed. And I said, well, when did you get back in? I'm not back in yet. It's been 4 years.
Well, and the math of it it's kind of strange because typically if you miss out on like 5 or 10 days throughout the year, you could miss a lot of the gains.
Big losses happen quickly, and also the gains can really move very quickly just by being in 1 week a year, that special week, whenever it is. And we don't know. We don't have that magic 8 ball.
Right.
When growing up, did you have a magic 8 ball?
Yeah, when I was younger, yeah. Mm-hmm. It didn't work very long. I broke it, I think.
Yeah, well, those things don't work when it comes to market timing also. So when we're investing our money, and the first quarter, we're talking about dollar cost averaging, where you're investing your money and you just keep buying and buying up and down. Now, talking about market timing is more about the core money. And so what happens is this: if you're not market timing, what are you then doing? And that is building a well-diversified asset allocation portfolio that has some money at risk and some money protected. Right, Alex?
Yeah. And so what you do is as you go along, you take some of your winnings off the table. I think Kenny Rogers said it best, you got to know when to hold them. Sometimes you want to keep your money, right?
And you know when to fold them.
Yeah, that too.
Sometimes you got to walk away.
So then the next question is, well, how do I know it's right for me, Brian?
Well, I think financial planning answers what's right for you. The hard part, though, is people get into things that they like and they know and they feel comfortable, and they'll put all their money into like one category or one set of stocks or one industry because that's sort of where their mind is. They understand that industry, but they don't understand it's okay to invest throughout the market and to diversify large, small, medium type stocks, the difference between value and growth stocks. And then sometimes it's extremely hard to get someone to invest internationally, to buy companies that are not part of the United States.
Yeah, they call it that home country bias. And a lot of people do it, but you can't. You got to spread your you got to spread your money across all these asset classes so that you don't have everything moving in the same direction.
Yeah, very true. I guess when I'm thinking about market timing and asset allocation and building your portfolio, I always view that as opposite of target date funds. Target date funds are taking your goal and putting it on like just a scale and timing, and they're basically annually reducing your risk and sending the money to bonds, and then they diversify it, and they typically diversify it in an extremely wide way. If it's held by a mutual fund family, they typically buy most of the mutual funds that they have at their family.
Yeah, but I mean, nepotism, it's been happening for years.
Yeah, well, that's part of the way the concept started. Now, it really started as 401ks got sued for allowing too much risk with the employees, and they actually in the 80s and 90s, even before, they used to have 80s, I guess it started. The 401ks would actually be invested, and they put all the money in the company stock, and that was your only investment choice.
That's a little much.
And they added a few more, but now they're basically telling everyone, here's your target date fund. We saw a new client probably 2 weeks ago. I think they were like 28 years old, and the portfolio moderate mix had them like 27% cash.
Yikes.
And they're just starting. It's like, get out of that. Let's go 100% stock. Oh, yes, I said 100% stock. but we're not going to be in and out of the stock. We're on dollar cost average. As we build it up, we're going to look at the allocation every couple of years and see how the allocation should change and reallocate. I'm not a fan of quarterly reallocation.
No, I think reallocation needs to be thought out because, sometimes you can do too much.
Yeah.
So if there's really no reason to do it, it's just why even do it? Because if things haven't changed enough, you don't really get any value out of it.
It changed enough. So a reallocation, let's say you have a portfolio and it's out of mix by a couple percent or 5% or 10%. When is the right number for someone to reallocate?
I mean, I think it's got to be over 5%. I mean, closer to 10. But it also depends on where they are in life. Like,
sure,
the last couple of years, the market has gone up like gangbusters, right? Mm-hmm. And people have asset allocation that's gotten a little bit out of whack because their risk assets have, in some cases doubled.
Yeah.
So you got to look at it from the top down. Like, okay, how much do I have? And then it's like, do I have enough? And then ask yourself, why am I taking this risk?
All right, Alex, this all sounds all fun and proper and a good planning answer, but let's talk reality. You and I have a 401k at Akers Financial Group,
yep, which
allows us to have a brokerage account where we can buy anything we want and we can buy it and sell it anytime we want. Isn't it fun trading?
I love it.
Right. You love trading. Now, trading, is that market timing, or how would you justify it within the market timing concept?
Well, I personally like to pick entry and exit points. On stocks, right? So if I like the name, then I will set a target to get in and a target to get out.
So that's trading, not market timing. Market timing would be if you're going to go all the cash.
Right. So if I'm trying to say, everything's going down, I need to move everything to cash, that would be market timing, right?
Have you ever tried that in your career? You don't have to admit to that. I have. I've done it, and typically I miss. There's no way to get too perfect. You can't get a perfect out and a perfect in. It's extremely hard to do. You can get it right maybe once, and then the next time you're going to mess it up really bad. So the idea is about the time in the market rather than timing the market. The time you stay in the stock market is the key.
And I'd rather be invested in something, right? Because inflation's a real thing. I mean, just in my lifetime, cars have tripled in cost, right? So it's a real thing. So cash is not going to get you there.
Right.
So the market or some type of asset class that's not cash, that has the potential or, the risk involved, but has upside potential, that's where I think you need to be.
I believe what you're just saying is that instead of cash, why not have investments that pay for holding them? Those are dividend-paying stocks, companies that actually pay you. They give you part of their profits. I think that's a good way to think about investing, is having some of your portfolio in value stocks, in dividend-paying stocks, so that you are receiving some money. So in a volatile market goes down, the dividends come, you can actually be buying more of the shares as it goes down.
And what you're saying is very important. Own companies that make money.
Oh, you mean profitable companies?
That's it.
You mean not ones that have a great idea or a great story?
Right. So like a lot of this growth name, some of these companies don't make any money.
Yeah.
They just lose money. It's the thought, the hope, the future. And, you see the market process that through different cycles. And, at the end of the day, flight to quality.
When I think about my clients that have been extremely successful at a young age, typically they began by being great savers. The second piece is that they dollar cost average and put it in the market, and then they kept investing in the market over time. And they let the money grow, and they worked with that money. They did not get out, didn't panic in the short runs. They kept investing and buying. And their long-term result was just absolutely incredible for them.
Yeah, and that saving, that pattern, that, if the earlier you start, the easier it is. I mean, it really is.
Absolutely. If you take the time value of money and you give yourself 30, 40 years to save, and you start early at your first job and you save for your retirement, your money will have more time to grow, more time to multiply. That's exactly what you need to do when it comes to investing. So far we covered two of our secrets. The first one is dollar cost averaging. Second one is market timing doesn't work. All right, we still got two more to go. Well, let's close out this quarter with the following. Akers Financial Group is a local, an independent financial group. We don't report to a big company on Wall Street. We report to you. We do have offices in Lutherville and Forest Hill. This is all about you. This is all about your retirement. That's what we're talking about when we talk about winning in retirement, is how can you be winning in retirement? We believe it starts with a free meeting with one of our team of advisors at Akers Financial Group. Go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and one of our team members will call you back on Monday to schedule a phone meeting, virtual Zoom, or an in-person meeting with one of our team of advisors. Start planning for your retirement now. Go ahead and give us a call at 833-946-7384 or visit our website at akersfinancialgroup.com. Would you cross a bridge with no guardrails? And what does that have to do with your retirement? We'll explain in the second half.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm your host, Brian Akers. Here with me today is Alex Monk. We are both certified financial planner practitioners. What that means is that we are financial advisors, here to advise you on your retirement. Now, it's a radio show. It's general information, of course. And what happens is we make an offer that you can come in and talk to us for a free meeting. That free meeting is we talk about your exact situation. We call that your financial fingerprint, about who you are, what's going on in your financial life, and what are your goals, and how to implement this across your financial situation to make it work best for you and your family. All right. So, Alex, we got this important question, and I think it's probably best if you ask the question instead of me.
Yeah. So I'll ask you, Brian.
All right. Cool.
Because you know my answer. But would you cross a bridge without any guardrails?
No way.
Like, let's say the Bay Bridge, right? Let's just say the sides fell off.
Yeah, okay, there's no sides. They fell off. Would I cross the bridge? The answer is no way. I was not crossing the Bay Bridge without guardrails.
Okay. So why not?
Well, I mean, the idea of guardrails is the fact that when they're built and they're there, they make me feel comfortable, so comfortable that I can go the speed limit or greater and fly across that bridge.
Have you ever had to use one?
I've never tested a guardrail by bumping in just to see if it works. I don't park the car, go test it. I didn't go research who built it. Just the fact that the guardrails are there make me feel comfortable to full steam ahead.
Right, and it's something that you hope you don't have to use.
Actually, absolutely.
I mean, right? I mean,
yeah.
The Jersey wall, I mean, whatever they call it. I mean, it's there for a reason.
Yeah, it is. And it does work very, very well to save many lives, because you might want to go right down the middle if there's no guardrails. But when you get up there and the wind starts blowing, who knows?
I mean, so the math of big losses is kind of the point of this, right?
Yeah. I think that when you think about retirement and you're crossing into that retirement and you're going to go across the bridge into retirement, why would you really want to try to invest your money without any guardrails at all? Of course, if you have big losses, you don't want to go back to work. What you got to do is have some guardrails so that you can stay focused and in and through your retirement years.
Right. And so the thing about retirement that's different than saving this whole time is you need the money. You know, you're not adding to it, you're taking it.
Right. So you work your whole life, and your job and what you're doing creates the income that comes in. When you retire, all of a sudden your work that created a pension or a Social Security payment or your investments are now required to give you the money that you and your family needs. And so the most important thing when it comes to retirement is your money needs to work as hard as you did.
Right. And so here's the catch, right? So when you need this money, let's just say, for example, everything you have is in the stock market and that market goes down, you don't have a choice but to sell, right? Because you got to live, you got to eat.
Yeah.
So you don't have the ability to wait things out. So you got to have proper asset allocation. You got to have a plan, different buckets of money, and kind of an idea of where's my next meal coming from. Because if you lock something in, you know, that's the toughest thing to make up.
Right. So when we build portfolios, what we're looking to do is to have an allocation that has a proportion protected with guardrails that you won't lose the principal, to lose the money you work so hard for. The reason is that we don't want you to go back to work to make up the money that you might have lost. If we have all of our money at risk, that risk is the actual loss of your money. And that's why you have to look at what you're doing to make sure you have it well balanced. Make sure that you have some guardrails into your retirement years.
Yeah, so the unrealized versus realized, meaning you don't lock in a loss until you sell it.
Yeah.
But when you need cash, you don't have a choice.
Yeah, I'm not a fan of the excuse, oh, it's not a loss yet, I haven't sold it. It's like, yeah, it's a loss. Look at the statement. If you want to cash it in right today, that's what it's worth. Now, when you think about it, the market has a small 10% loss, and that's called a correction, right?
And that's normal. That's healthy.
Yeah, so a 10% pullback, you actually have to make 11% on your money to get back up to where you were. And that's to get the net effect of a zero.
Yeah.
So this concept that big losses are hard to make up is the fact that if we lost 50% on an investment or on a stock, you have to make 100% on that money to get back just to where you were.
Yeah. So then what do? Do you take additional risk? Like what's the answer? And if you don't have good asset allocation, it can be scary.
Well, some people who haven't saved their whole life, what they say in those first few meetings is, oh, I need to take more risks to reach my goal because I have a short time period. And I'm like, well, let's really look at your budget. Let's try to shrink that budget down so that our goal is not as high. So that our number or what we need to accomplish is lower so that it's achievable without risking everything.
Right. And it's very counterintuitive, right? So the more that you have, the more ability that you have to take on risk because you have that core, that base, right? That guardrailed money.
Yeah, the problem is when you think about it, the more that you have, the more you can take on a risk. The problem is that I found is that the more you have, a lot of times the more you spend. So imagine someone wants to retire on $250,000 a year. How much money do they really need to have saved to try to do that?
Right. And how old are they?
Well, yeah, right. So, but $250,000, is that before tax or after tax? Imagine if somebody wants $250,000 after tax. I mean, they're in that 35% tax bracket, another 7-8% for Maryland. They're basically in the 43% of their money. So they got to take out over $400,000 a year to get to $250,000. Yeah. Now, when you're doing the investment math, that means you might need how many millions of dollars?
So if that's 4%, that's 10 million.
10 to make it easy to provide $400,000. That's an easy way to make it last. But 10 million is the rare client, right?
I mean, that's a lot of money.
Yeah.
I mean, that's a lot of money.
Right. So if you use a 4% withdrawal rate and you have $10 million, that's around $400,000 a year. You pay tax, you get in that $200,000 range of net. $270,000 net after tax. And the hard part there is that doable? Now, the reason we think planning has to work with everyone is that if we reduce our need, reduce our debt, the outflow of money, then our need goes down, our income flow, the required income need gets reduced, and then we can make it a doable plan for you and your financial future. We've been talking about investment ideas, investment secrets. First one was dollar cost averaging. Second was market timing. And this third one is this. Do you have guardrails? I believe that if you have a high income need, the higher it is, the more guardrails you need. As your income need drops down, you can actually take less risk, more risk with your money because you don't need it for income.
Right. And then, it's just crazy the math on the taxes too. So having good tax planning is very important as well.
Well, if you think about the dollar cost averaging concept, why not dollar cost average into a Roth IRA your entire life? Put that money in. Maybe you think about, I'll max my 401k match, and then I'll save the maximum Roth that I can. If I'm under 50, I can save $6,000, I think. And then you put that money away, let it grow, put it $500 a month, and just let it grow in a Roth tax-free for retirement. So that when you get to retirement, you're going to have buckets of money. Some buckets of money that are tax-free to you and your family, and some buckets that were all pre-tax deductions, but they'll be taxed at your retirement years.
Right. And so that pre-tax money is, basically 30% of it doesn't belong to you. So you got to think about that. Like, okay, do I have enough saved? Do I have the right kind of money saved? And how can I get better at it? And that's where we come in.
All right. So you start thinking about guardrails and what protects your money to the future. Good tax planning can be one of those guardrails where, hey, I already paid the tax when that money was smaller. And no matter what happens on the tax rate to the future, I'm not going to be paying any more tax.
Right.
And that might have been your move to a Roth through conversion or contribution.
And then your downside there is, oh, I paid tax already.
Yeah, it's done.
It's done. So
it's like any money you've already spent. You don't remember it.
or sometimes you do if you haven't paid for it.
Oh, you mean when you get a credit card statement and you go, wow, that was an enjoyable vacation last summer and I'm still paying for it.
Right. So
yeah, that's not fun.
The banks are giving you what, 0 on your money, and credit cards are charging
as high as ever.
Yep.
I don't see those rates dropping at all.
I don't see that. So that's a good investment too, is pay off your debt.
Yeah. There's so many financial planning concepts that apply when it comes to investing. We try to break it out into some simple ideas. This segment, the third quarter here, is about guardrails. Do you have a guardrail in your investment portfolio? Guardrails are investments that have protected principal and possibly protected income that you can draw and retain the ability to have the money for beneficiaries. There are a lot of different ideas that are out there. We just want to talk about the concept of, have you looked at even having guardrails on your investment portfolio?
And retirement is definitely a game of cash flows. So these guardrails, they need to be that, what do they call it? The core.
Yeah, the core part of your investments. Like if you're a day trader, you don't have guardrails on your day trading unless you buy options or something. But the idea is the fact that you would have money that's going to be a lifetime money that you're going to set aside, and then you can trade the rest. You trade a portion. You don't trade it all. As you invest and grow to your future, you need to balance your portfolio to money for a lifetime, and then you have your money that you can invest in other ways.
Well, that sounds like play money.
Well, in some cases, I do call it play money. I don't want to offend people by calling their day trading play money. But when all of your money is in your trading account, you got to wonder, are you taking too much risk for your goal? And that's really a core issue when it comes to financial planning.
Yeah,
go ahead.
The greed factor, too. So you see the markets and they run up. That's when people, they keep getting in. They try to do the things we talked about earlier. They're trying to time the market. And that's when you get hurt.
But when things start to go down, then they all want to get out of it. It lost went down 20%. So, well, why is it down 20? And it might just be some profit taken on by some shorter term traders, and the company hasn't changed at all. It might be a great time to buy more when they do go down. Retirement planning is about you and your goals, your timing when it comes to what year you want to retire, what flow do you need for income. Working this all out is very important. But the key thing is this: if you don't save now, you'll not have the money to plan for later. You need to save. You need to invest. You need a dollar cost average. You need to not time the market. And as you get closer to retirement, put on some guardrails that your portfolios don't take swings where you might fall off the bridge. We want the best part of retirement is what is going to be when you get your time back, where you decide how to use that time. Before retirement, your time is tied up with many other commitments, mainly your job. A lot of that goes away when you retire, and it's consumed by what you want to do. We want you to begin to win in retirement, and go ahead and give us a call to schedule that free meeting with one of our team of advisors by calling us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message. We can set up this in-person meeting, or we can do a Zoom meeting or a phone call, whatever is best for you. Of course, we love the in-person meetings if possible. Start planning for your retirement now. Give us a call, 833-946-7384, or visit AkersFinancialGroup.com. What's more important to you, reaching your goal or taking risk? We will explain in the fourth quarter.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
I'm Brian Akers, and here with me today is Alex Monk, and welcome back to Winning in Retirement. Our show today is called 4 Investment Secrets for Your Retirement Future. We put this show into 4 different quarters, and here we are sitting in the fourth quarter, ready to bring you the final bit of information and bring it all together. Our shows are on our website at AkersFinancialGroup.com. You go there and click on the radio tab. You can hear a recording of our show. You can also check us out on most podcasts. Most podcast sites have a radio show popping up on there now, too.
I like that.
Yeah, it's just good information to find, and then you can listen to it whenever you like, which we actually do listen to ourselves. It's not fun to hear your own voice on the radio, but it's good to hear if you're talking okay, or if you need to talk slower or faster or have more emotion. Right, Alex?
It's so difficult, but yeah, I agree.
So how do you feel about the fourth quarter?
This is my time. I love the fourth quarter.
Do you like fourth quarters where you have the lead or a little behind? What's your favorite fourth quarter?
Oh, it depends. I just like to win.
I like to be way up, and so the game's over. When you're coaching. That's the best way. Is when the game's over, you're basically trying to figure out who's going to play next. You're not really truly trying to win the game. It is more exciting a come from behind win, and it's a lot of fun, especially being a basketball coach. Now, being a financial advisor, it's a lot like coaching. And what we try to do is we talk about the client, and we want them to be already winning when you enter the fourth quarter. We don't want to have this winning in retirement. Let's do all these things right now to make it get better. Well, sometimes we have to do that for people. In some cases, we got to say, won't you wait a little bit as we get everything organized? We want you to win in retirement because you're prepared to win in retirement. All right, this final segment of our show, 4 Investment Secrets. This is the question, Alex. What's more important to you, reaching your goal or taking risk?
Well, I mean, I think everyone would say they would say reaching goals, right?
It sounds like you have a multiple choice. Oh, that sounds like the good answer is to basically reach your goal. But the sad part is many people love the risk. They love the thrill of the risk to a point where it's going to do the opposite of reaching their goal.
Oh, yeah. So like you said earlier, trading's fun. The risk is fun.
It's good to tell stories, almost like fishing stories. I caught one this big, that kind of thing. But the reality is this: retirement and knowing your money's taken care of and the money's coming in, and you breathe that retirement breath like, I'm good. That should be the retirement goal. That should be that moment when actually I did do it. It worked. Yeah. Rather than the thrill of just getting a win, it's the victory. It's the winning the entire battle in retirement.
Yeah, and that calm, right? So that I don't have to worry, right? Because you spend your whole life working, saving, yada, yada, yada. But really the goal is to be financially independent, right? To wake up and be able to say, you know what, I'm going to do what I want to do today.
Mm-hmm. I mean, I enjoy seeing our clients who had a goal of retiring maybe to a different state, is to go visit them that first year after they retire and to see how they're doing and to see what's changed, how are things settling out. And it's awesome to see them, to see the light in their eyes and, oh yeah, this is it, we've made it. And then we talk about things. And then we talk financial planning after we've talked an hour about what's going on in their new place.
Right. And that's it's an exciting stage of life. If you put the work in, right, you want to enjoy that. Like you work hard. I mean, I know we work hard. So it's like at a certain point, you want to enjoy the fruits of your labor.
Yeah, it's just any financial plan that you do is a long-term plan, not a short-term plan. If you're thinking about financial advisors and how they're working with you, if you haven't been with an advisor 3 years, you haven't given them enough time to understand where they're taking you and what's going on. Yeah. Financial advice is about now, it's about tomorrow, it's about next week, it's about next year. And most of us in financial planning want to take the least amount of risk to reach your goal, not the most amount of risk. So if we had a couple come in, stereotypically, the male might be the trading kind and the female would be more moderate risk or lower, right?
Yeah, or like, I don't know what he's doing over there.
Well, and that's not every case anymore. I mean, it's not the normal case. There's no such thing as a normal case when it comes to investing because you never know people's history. But the idea is this: are you loving taking more and more risks, especially when you're a couple of years away from retirement and you look at your investments and you're like 100% stocks? Is that really the best thing for your retirement plan?
Yeah, and that's assuming that you know this, right? So some people may not even know how much risk they got.
It's amazing how many people that we meet with have never put it all together. So when they call and set up a free time with us, we have them come in, they bring information. And in that second meeting, we put it all together to show them where their assets are. And then we write out, yes, in writing, where their money is and what it's doing for them. Now, some of you might be collectors of investments. Some of you might be investors. Some of you might not be investors at all. What happens is you need to know what you have. And so we got to start with the financial fingerprint. Where are you now with your money? Set that money aside. Make sure you are knowing why you put money aside, where it is, and does it all fit your plan now?
Right, because most people, when you're changing jobs, you're not focused on your old job's retirement plan, right? You're busy. We're learning the new job, filling out all that stuff, getting started, yada, yada, yada. Now you're 6 months down the road. And that thing never even existed.
Yeah. Or you get a little notice from a former company and he said, oh, we changed providers on the retirement plan and your money was switched to this. And you're like, hey, I'll get to that. Yeah. And you put that in that special pile at your house. Many of you have that pile. It's usually sitting on a counter until there's a party at your house. And then all of a sudden you put it in a drawer and it stays there for years. You just forget about doing it.
Yeah. And a lot of people, when you bring it all together and show them everything, they're like, oh, wow.
There's a Warren Buffett. He's an investor. I think he's been around a couple of years. One of his many sayings. One is that it's insane to risk what you have for what you don't need.
Yeah, that's pretty deep.
I think that's the concept of what is your required rate of return in your retirement years. What I mean by that is if you risk your money to make 10, 15%, do you really need that 10 or 15%? Because you could easily lose 10 to 15% on the downside and then have to lower your income to your future.
Right. So like what's more important? Having what you need or having more than you need?
I think the answer is total return.
Total return. What does that mean?
I was going to saying, but total return on your heart, but that doesn't really sound right. The total return is this: your investments, your income, your dividends, your portfolio that's in protected. It might be making 3-4%. You have your stock earning like 8, 12 or higher. You bring it all together. And that total return, we would like to see that your money keeps up and or beats inflation after tax. It's got to do both. When inflation has short-term, really high spikes like it's having right now, what you got to understand is that your money has to beat inflation just to keep up, just to stay even. And so you got to invest in a way to do that.
So you're telling me that I just can't put it in the bank?
You can't have your entire portfolio earning zero and expect to keep up with inflation. Now, some people might have saved a tremendous amount and live off very little, and that might work for them because they don't have any required return to meet their goals.
And that's a very rare case typically, right? So, and even in that case, right, you would still want to have some return on your money because it would be foolish not to have it work for you.
Especially when you have a low need, that means you can invest and take a little bit more risk depending on if you have a goal for legacy for the family or if you have other goals, whatever they may be. It might be charity, could be really anything you can dream of.
And people come in and they ask me, well, how should I invest this? And then I ask them a question back and I say, well, what's it for?
Yeah, giving money purpose is what will help you reach your financial goals. All right, so today's show has been 4 investment secrets for your retirement future. The first one we talked about was dollar cost averaging. Give us a quick summary of dollar cost averaging, Alex.
That is not picking one entry date. That's constantly saving into the market, into volatile, risky assets.
And that was the first quarter. Second quarter, we covered market timing and why that would not work and why you should not try market timing in your portfolio investment. You need to use asset allocation and diversify instead.
Yeah, it's a fool's errand, I believe they call it.
Ooh, that sounds pretty big. All right, and the third segment, we talked about having guardrails. Do you have guardrails on your portfolio? What do we mean by that?
Are you protected from big losses?
Yeah, so if your whole portfolio is exposed to big losses, that means you might have a long time to come back.
Yeah, and it's like falling off a bridge, right? You may be okay. There's a chance you're not.
Sorry, I don't have a good response for that. But you did say falling off a bridge. If there's a guardrail, try not to test them. Believe that they're there and that they're sturdy and stay away. But that allows you to get across the bridge.
Right.
And then the fourth quarter, what we've been talking about is this. And that's all about the risk that you're taking. What is the required risk that you need to reach your goal? If you've been saving well and living within your means, you'd be amazed how retirement can work with lower risk than the actual market. If you compare all of your investments to 100% like a stock index, you should earn less than that in your retirement years because you do not risk it all.
Right. You got to risk it for the biscuit, but you don't want to take all the risk of the market because I think you said at the beginning of the show before we got into all this, there was a decade there where the market was negative.
Yeah, so we never know when that might happen again. We just have to be prepared for that downside. Now, a good, solid financial planning, you set your goals after you've built your fundamental financial plan. That fundamental financial plan is where you have proper insurance, you have an emergency fund that covers expenses and anything short-term, up from 6 months up to a year. Then you pay off all personal debt that's not asset-based, and then you build a retirement future. As you get to retirement years, we want you to be entirely debt-free so that you can spend what used to be your mortgage payment on health insurance. Because it's really impossible to prepay a lifetime of health care, but you do have to pay it. And that's going to be something that's going to be a big part of everyone's budget throughout their retirement years. And you must prepare for that and also prepare for a 20 to 30-year retirement or longer.
Yeah, I mean, and you want to have health insurance. I mean, let's be honest. It's like having no guardrails. It's terrifying. I couldn't do it.
Yeah, the guardrails has always stuck with me. It's just a great concept when it comes to how are we doing? What should I be doing? Because I believe that having some money with no risk should make you feel more comfortable being able to retire, knowing that you're not risking it all and that you can actually count on your money. All right, Alex, thanks for a great show. Appreciate it. Now, for all those listening, today we covered our 4 investment secrets for your retirement future. You can go to our website at akersfinancialgroup.com and check out our radio tab. You can hear the show again. You can hear different segments. You can hear on past shows we have on that site also. You also go to our webinar tab and check out some webinars that we've been putting up there over the last couple of years. At Akers Financial Group, we want you to win in retirement by taking advantage of an opportunity to begin planning with us. To schedule your free meeting with one of our team of advisors, go ahead and give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. When you call, leave us a voice message, and one of our team members will call you back on Monday to schedule a phone meeting, virtual Zoom, or an in-person meeting with one of our team of advisors. Start planning for your retirement now. That's 833-946-7384, or visit akersfinancialgroup.com. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.